Welcome to the TAC Index AI podcast, May 27, 2026, where we blend TAC IP data reports and charts with the latest news in all things logistics with a focus on air cargo. So today we are taking a deep dive into, well, a pretty massive contradiction in the global data.
Yeah, it is definitely a weird one.
Right, like imagine paying, I don't know, nearly 80% more for jet fuel than you did last year. But then you look at your dashboard and it says your overall freight costs are actually easing. That is exactly what we are untangling for you today.
So let us start with the TAC index data. The global Baltic air freight index, the BAI0, it actually ticked down slightly by negative 0.2% this week.
But I mean, anyone managing logistics right now knows that does not exactly feel like relief.
No, not at all.
Because we are still sitting almost 30% higher than this exact week last year. It is like taking your foot off the gas, but you were still doing, 90 down the highway.
Yeah, the baseline has totally shifted, and to understand why, you really have to look at the fuel spread. So jet fuel prices drop about 15% month over month.
Which usually pulls freight rates down, right?
Right, exactly. But year over year, I mean, jet fuel is still running nearly 80% higher.
Wow, that is wild.
Yeah, so that massive premium acts as this rigid floor under the market. It basically prevents freight rates from normalizing even when the underlying demand softens.
And, that floor is not exactly stable either, because energy markets are just taking wild swings right now. Brent crude slipped to $98.70.
Exactly.
A lot of that volatility tracks back to February, with that shaky U.S.-Iran truce keeping traders constantly on edge.
Well, and that instability in the Middle East is not just a pricing issue. It is literally rerouting aircraft. We can see this disruption clearly when we look at regional TAC index hubs. So Shanghai's outbound index, the BAI80, crept up 2.2% week over week.
Right, while Hong Kong eased slightly.
Exactly. But look at Europe. Frankfurt jumped 7.6%. Meanwhile, London Heathrow dropped almost 3%. And the usually volatile Chicago index took a massive 12.9% dive.
Okay, wait. I have to push back on reading too much into that Chicago drop, though.
Oh, go ahead.
I mean, a 13% plunge in the U.S., while Frankfurt surges 7%. That feels less like a synchronized global shift and more like, localized routing chaos. Is Frankfurt just absorbing the shock of Asia to Europe conversions because of the Middle East disruptions, while Chicago sits insulated?
You hit the nail on the head. Frankfurt is catching the direct fallout of Eurasian airspace and Red Sea maritime disruptions. Sea freight from Asia to Europe gets delayed, so desperate shippers convert to air freight.
Right, overwhelming hubs like Frankfurt.
Yes. And Chicago, being mostly driven by trans-Pacific trade, does not face those same localized bottlenecks right now.
So we are basically seeing intense, localized capacity crunches that are masking a broader global cooling in the data.
Precisely. And this is actually starting to really worry macroeconomists. The Bank of Japan just warned that this sustained energy and supply shock could morph into a persistent systemic issue. If companies price these volatile costs into long-term contracts, it shifts wider price-setting behavior permanently.
Wow. And the supply chain has another massive variable hanging over it right now on the regulatory side.
Yeah, the tariff situation. And just to be clear for everyone listening, we are just reporting what is in the source material here. We are not taking any political sides.
Exactly, just laying out the facts in the reports as they're written.
Right. So USTR Jameson Greer stated that the global 10% tariff proposed by the Trump administration could potentially be reimposed.
Since the current waiver expires in July, right?
Yeah. And since the underlying statute does not explicitly limit the action, those tariffs could theoretically snap back into place overnight.
So for you, the listener, whether you are managing international supply chains or just trying to forecast macro stability, you are looking at a brutal trifecta. An 80% year-over-year anchor on fuel, wild regional capacity imbalances, and the potential for a blanket 10% global tariff.
When you stack all that together, it leaves us with a critical question to think about. If unpredictable energy shocks and rolling global tariffs are no longer just cyclical disruptions, but the permanent environment, how does the fundamental concept of normal air cargo capacity need to evolve to survive the next decade?
Until next time.